Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session in which we are going to discuss two very important RBI press releases, two very important news articles. Okay, so first of all, we are going to discuss about the RBI that has released the list of the NBFC upper layer. So what is this NBFC upper layer? In the scale-based regulatory framework of the RBI, how the list is prepared. So all of this we are going to discuss. We are going to have the basic idea of the scale-based regulatory framework, and we are going to understand that how this list is prepared, what are the parameters for preparing this list. Okay, so this is very important regulation of the Reserve Bank of India, the scale-based regulatory framework. And in this regards of the regulation, we are going to understand the whole news article. The second news is regarding the RBI that has announced the measures to manage the liquidity conditions. So there are 3 steps that have been announced by the RBI. So we are going to discuss about these 3 steps, and in the descriptive answer writing later on, you can use such steps in regards to the management of the liquidity. Okay, so these both news articles are very important from the RBI Grade B examination perspective, as you are going to get points for your objective part of the examination, and you are going to get points for your descriptive answer writing also through this session. So good morning everyone. Good morning Guru Rajesh, Sorish and Nitya. Welcome to the session. So today we are going to discuss these 2 important news articles, the 2 press releases of RBI. But before starting with that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel where you will get the PDF of the session. Okay, so do join the Telegram channel. The link for the Telegram channel is provided in the description box below. Okay, so let's get started with the first press release of RBI, or with the first news of regarding the RBI, that the RBI has announced the list of NBFCs in the upper layer under the scale-based regulation for the NBFCs for the year 2024-25. So this list has been prepared, this list has been released by the RBI for the NBFC upper layer. So first let's understand about the scale-based regulation for the NBFCs, the scale-based regulation of the RBI. So first of all, the Reserve Bank of India issued the scale-based regulation, a revised regulatory framework for the NBFCs. So this was released on October 22, 2021. So in October 2021, there was the scale-based regulatory framework that was released for the NBFCs. Under this scale-based regulatory framework, the NBFCs are divided into 4 layers. So the NBFCs are divided into 4 layers. So these 4 layers are the base layer, the middle layer, the upper layer and the top layer. So the NBFCs are divided into these 4 layers on the basis of the size of the NBFCs. So the smaller the NBFC, it will come in base layer. The larger the NBFC, it will come in upper layer or top layer. Okay, so on the base of size, on the base of activity that they are doing, and on the base of the perceived riskiness, the NBFCs are divided into 4 layers. Okay, so regulatory structure for the NBFCs shall comprise of 4 layers. So there are 4 layers of the NBFCs, or there are 4 layers in which the NBFCs are kept. Now these 4 layers are decided on the basis of the size, activity and perceived riskiness. The lower the size of the NBFC, the lower the layer it will reside in. So basically the framework categorizes the NBFCs in base layer, middle layer, upper layer and top layer, and gives in the scale-based regulatory framework, there is the methodology that is given to identify the NBFCs in the upper layer as per their asset size and the scoring methodology. So I hope till now everything is clear, that the NBFCs are divided into 4 layers. The lower or the smaller the NBFC, in the base layer it will come. So let's see that which NBFCs come in which layer. So base layer shall comprise of non-deposit taking NBFC. So non-deposit taking NBFCs means these NBFCs are not taking the deposit. They are not getting connected with the public directly, and they are not taking the funds from the public. And they have the asset size of below 1000 crore. That means they are considered small NBFCs because they have the asset size of less than 1000 crores. As well as the NBFCs undertaking the following activities such as peer-to-peer lending platform, the NBFC account aggregators, the non-operative financial holding company, and NBFCs not availing the public funds or not taking the public funds and not having any customer interface. So such NBFCs will come in the base layer. So I hope you have understood that the small NBFCs will come in the base layer. Then coming to the middle layer, all the deposit taking NBFCs, they are taking the deposit of the public. So let aside the asset size, whatever is the asset size, if the NBFC is taking the deposits, so it will come in middle layer. Okay, the NBFC, all deposit taking NBFCs will come in middle layer irrespective of their asset size. Non-deposit taking NBFCs, if they are bigger, that means if they have the asset size of 1000 crores or more than 1000 crores, so these NBFCs will also come in middle layer. As well as the NBFCs undertaking the following activities: standalone primary dealers, housing finance company, infrastructure debt fund, infrastructure finance companies. So these will come in middle layer. Okay. So on the base of size, on the base of activity, the NBFCs are divided into base layer or middle layer. Now in the upper layer, so upper layer shall comprise of those NBFCs which are specifically identified by the RBI. So the top 10 NBFCs on the basis of their asset size. So the biggest of the 10 NBFCs on the basis of their asset size will always reside in upper layer. So the top 10 eligible NBFCs in terms of their asset size shall always reside in the upper layer irrespective of any other factor. As well as there is also a methodology, that has been identified by the RBI, that has been laid down by the RBI. On the basis of this methodology, there are some NBFCs that are selected to be kept in the upper layer. Okay. So on the basis of the risk assessment, on the basis of the methodology of the RBI, there are certain NBFCs that are kept in the upper layer. So upper layer shall comprise of those NBFCs which are specifically identified by the RBI as warranting enhanced regulatory requirement on the basis of some parameters, because they are the risky NBFCs. Okay. So we have understood that some NBFCs will be in base layer, that are the small NBFCs and that are doing activities that are not very harmful, we can say. Then middle layer, then there is the upper layer. Now the higher the layer your NBFC is kept in, the more the regulatory norms you have to follow of the Reserve Bank of India. The base layer NBFCs have to follow the least of the regulatory requirements by the RBI. Middle layer has to follow higher regulatory requirements of the RBI. The upper layer has to follow even higher regulatory requirements by the RBI. Now the top layer, it ideally remains empty. This layer can get populated if the RBI is of the opinion that there is substantial increase in the potential risk in some of the NBFCs. That means some of the NBFCs are becoming very risky. So in the upper layer, the most risky NBFCs are kept on the basis of their asset size, because they are the biggest of the NBFCs. So they are kept in upper layer, as well as on the basis of the methodology of the RBI. On the basis of the methodology of the RBI, the most risky NBFCs are also kept in upper layer. But if RBI thinks that these NBFCs are becoming even more riskier, so these NBFCs will be transferred from the upper layer to the top layer. So this is the idea, that if the perceived riskiness is even increasing more, so the NBFCs will be transferred from the upper layer to top layer. Upper layer to top layer. So that will happen, that even more riskiness means that your NBFC will be transferred from the upper layer to top layer, where you will have to follow the highest of the regulatory requirements by the RBI. So this is the idea, that on the basis of size, on the basis of activity, and on the basis of perceived riskiness, there is the division of the NBFCs in between the four layers. Okay. So here you have seen that now categorization of NBFC is carrying out specific activity. So on the basis of activity also there is the division that has happened. Okay. That NBFC peer-to-peer, NBFC account aggregator, the non-operative financial holding companies, they will always reside in the base layer. They will always reside in the base layer. Okay. Now the NBFC deposit taking, the CIC, the IFC, HFC, housing finance companies and such. Here you have seen the name, core investment companies, standalone primary dealers. So NBFC deposit taking, core investment companies and such, they will be included in the middle layer or upper layer and not in the base layer. So they will either come in the middle layer or they can come in the middle layer, but they will never come in the base layer. As the case may be, SBD, that is the standalone primary dealers, and the infrastructure debt fund, NBFC, they will always remain in the middle layer. So standalone primary dealers and the IDF, NBFC, the infrastructure debt fund, they will always come in middle layer. while the CIC, deposit taking, and the HFC and IFC, they can come in middle layer or upper layer. The remaining NBFCs, that is investment and credit companies, microfinance institution, factors, mortgage, guarantee companies, could lie in any of the layers of the regulatory structure depending on the parameters. Now the government owned NBFC shall be placed in the base layer or middle layer. They can not be placed in the upper layer. They will not be placed in the upper layer. So this we have discussed. Now what is the methodology according to which the list has been prepared? So if you have seen the list that the RBI has recently released, so if you have seen the list that the RBI has recently prepared for the NBFCs, here you can see that there are 15 NBFCs that are kept in the upper layer. There are 15 NBFCs that are kept in the upper layer. Now the top 10 NBFCs, on the basis of their asset size, they are kept in the upper layer. But what about the other NBFCs? Why the extra 5 NBFCs are kept in the upper layer? So that is according to the methodology that the RBI has stated on the basis of the perceived riskiness. Okay. So let's see that. So this is the methodology that the RBI has determined. First of all, the top 10 NBFCs based on their asset size will automatically fall in the upper layer. So this is the methodology that the RBI has notified regarding the selection of the NBFCs in the upper layer. So there are the parameters, the quantitative parameters and qualitative parameters. Now first of all, scoring methodology for identification of an NBFC as an NBFC upper layer shall be based on the set of NBFCs that are fulfilling the following criteria. So first of all, if the NBFC is in the top 50 NBFC excluding the top 10. So this is the list of NBFC excluding the top 10, the next top 50 NBFCs, from this there will be the methodology that will be seen in the top 10 or top 50 excluding the top 10. Based on their total exposure including the credit equivalent of balance sheet. Okay, so the top 50 NBFCs on the basis of their exposure, on the basis of their balance sheet, the top 50 NBFCs that are below the top 10, because these top 10 are automatically coming in the upper layer. So the next top 50 NBFCs, on that the methodology will be tested. NBFC is designated as NBFC upper layer in the previous year. So they will also come under the criteria on which the methodology will be tested, and NBFC is added to the set by supervisors using supervisory judgment, that the supervisor has said or the regulators have said that okay, this NBFC seem to be somewhat risky. So such NBFCs, on these NBFCs the methodology will be identified or the methodology will be tested that okay, out of these NBFC, which NBFC should come in upper layer. So NBFCs that were previously kept in upper layer, so on that the methodology will be tested again. The NBFC that is added by the supervisor in the list, on that the methodology will be tested, and the top 50 NBFCs excluding the top 10, on that the methodology will be tested. So the methodology is what? There are these parameters. So quantitative parameters and qualitative parameters. Quantitative parameters hold 70% of the weightage and the qualitative parameters hold 30% of the weightage. So quantitative parameters means that the NBFC, the size of NBFC. If the NBFC is big, that means it can have more riskiness in the financial system of the country. So the size of the NBFC. The leverage, that means debt to equity ratio. Let's say a company is taking a lot of debt and its shares or its actual value is very less. So that means this NBFC is also more risky because it has taken a lot of debt but it doesn't have as much of the value. So the quantitative parameters contain size and leverage. If the size is very high, if the leverage is very high, so that means the NBFC can be very risky for the economic structure, for the financial structure of the country. If the NBFC is very much interconnected with the other NBFCs and banks, that means if the NBFC fails, the other NBFC, if this particular NBFC fails, the other NBFCs, the other bank can also fail because there is high level of interconnectedness. Complexity, that means that the NBFC is very complex, it is handling a lot of different domains. Okay, these are the quantitative parameters. Qualitative parameter or supervisory inputs. So it has 30% weightage. The nature and types of liabilities, that in which kind of liability which kind of liability the NBFC has. The group structure, that how much it is interconnected with like how many entities are there in the group, in the relative group, okay, and segment penetration, that in the segment, let's say it is in the, let's say CIC, that is core investment company. So how much penetration has happened in the like if the NBFC is working in the core investment company domain, in the core investment domain, so how much penetration, how much of the core investment it is doing. So these are the qualitative parameters. So I hope this is clear that the methodology has been determined and there are these parameters under the methodology, and these parameters will be seen for the NBFCs as per these norms. So the top 50 NBFCs excluding the top 10 NBFCs, the NBFCs designated as the NBFC upper layer in the previous year, and NBFCs added to the set by the supervisors. So on these NBFCs the methodology will be tested, and these are the parameters under the methodology. Any confusion anyone has? So the NBFC in the upper layer, if there are like top 10 NBFCs on the basis of asset size will always reside in upper layer, but the additional 5 NBFCs that are kept in the upper layer, they are based on the basis of the riskiness, they are on the basis of this methodology. Any confusion anyone? Thank you so much, Suresh, means a lot. Any confusion? So despite qualifying, so now what the RBI has said as per the new list, so despite qualifying for identification as NBFC upper layer as per the scoring methodology, the Piramal Enterprises, so Piramal Enterprises as per the methodology, the Piramal this enterprise is identified as the NBFC upper layer, but it is not being kept in the NBFC upper layer because it is said that right now there is restructuring that is going on in the Piramal Enterprises Limited. So this enterprise, even though it is being identified as NBFC upper layer, but it is not kept in the NBFC upper layer because there is current review that is going on, and there is ongoing reorganization in the business group that is going on. Okay, so Piramal Enterprises are actually, or this enterprise is actually selected as the NBFC UL, as the NBFC upper layer on the basis of methodology, but it is not being kept in the upper layer because there is reorganization that is going on in the business group. Inclusion of Tata Sun Private Limited. So Tata Sun Private Limited, this has been included in the upper layer, and the RBI has clarified that this enterprise or this entity is kept in the upper layer. It is not because this enterprise has said, this entity has said that we want to cancel our certificate of registration. So actually Tata Sons Private Limited, it has said that we want to cancel the certificate of registration as a NBFC, that we do not want to work as NBFC right now. So they are kept in the upper layer. It is clarified by the RBI that they are kept in the upper layer not because they have said that we do not want to work as the NBFC. They are just kept in the upper layer because of the methodology. Okay, so inclusion of Tata Sons Private Limited in the list of upper layer is without prejudice to the outcome of its application of deregistration. So Tata Sons Private Limited want to deregister, and they have been kept in the upper layer not because of their request of the deregistration. This is the idea. The deregistration that is under examination. In terms of the framework, once an NBFC is classified as the NBFC upper layer, it shall be subject to enhanced regulatory requirement. It shall be subject to enhanced regulatory requirement. More regulatory norms it will have to follow, at least for a period of 5 years from its classification in the upper layer. So if the NBFC upper layer is kept, if the NBFC upper layer is kept in the upper layer category, so it will have to keep in the upper layer for 5 years, for at least a period of 5 years from its classification in the layer, even in case in the coming years it has achieved all the parameters. That means it is it is following the parametric criteria and it does not meet the parametric criteria. That means it is not very interconnected, it is not very complex and such. So even if it is not meeting the parametric criteria and it is following all the criteria of the RBI, still if the NBFC is decided as the NBFC upper layer, if the NBFC is kept in the NBFC upper layer, it will be kept in the upper layer for 5 years. So once the NBFC is kept in the upper layer, it will be kept in the upper layer for 5 years whatever the case be, even if the NBFC is following the guidelines of the RBI, even if it is not meeting the parameters, it is following the parameters or whatever, the NBFC once selected in the upper layer, it will be kept in upper layer for 5 years. Okay, so this is the idea that the enhanced regulatory requirement will have to be followed for at least a period of 5 years from its classification in the upper layer, even in case it does not meet the parametric criteria in the subsequent years. So this is the idea. Any confusion here? On a review, so RBI announces measures to manage liquidity conditions. Now coming to the second news article, the first one is clear. So on a review of current liquidity and financial conditions, the RBI has decided to conduct the following operations to inject the liquidity. So on the review of the current liquidity situation, the RBI has found that there is less liquidity in the market, there is less money supply in the market as compared to what there should be. So RBI has found that there is less liquidity. That means there is less money supply in the market. So RBI wants to increase the money supply, RBI wants to inject the liquidity into the economy. If RBI wants to inject the liquidity into the economy, what RBI should be doing? So RBI has said that it will be taking 3 steps. First of all, open market operation, purchase auctions of Government of India. So open market operation, this means that the RBI can sell the government securities or RBI can purchase the government securities. So open market operation means in the open market there will be selling of the government securities or the purchase of the government securities will happen. The RBI will either sell the government securities to the banks in the open market or the RBI will purchase the government securities from the bank in the open market. So now here particularly it has been said that the open market operation purchase auction will be conducted. So that means the RBI has said that the RBI will be purchasing the government securities from the banks, okay. So that means if the RBI is purchasing the government securities from the banks, that means RBI will have to, if RBI is purchasing, if I am purchasing this water bottle from you, I will be giving you money. So if RBI is purchasing the government securities from the banks, the RBI will be giving money to the banks. RBI will be giving the money to the banks, okay. So there will be more money that will flow into the economy. So this is the idea that RBI has said that the open market operation purchase auction, whenever RBI wants to increase the liquidity into the economy, whenever RBI wants to increase the liquidity into the economy, the RBI conducts the purchase auction of the Government of India's securities for an aggregate. Now the amount has been given that the open market operation purchase auction will be conducted for the aggregate total amount of 60,000 crores. That means this much money will be provided in the economy, and this money is being provided into the economy in 3 tranches, in 3 steps. That means in 3 like different timelines of 20,000 crores each to be held on January 30. So 20,000 crores of the government securities will be sold on January 30. Then on January 13 and February 13 and February 20. So you can understand that the RBI has said that we will be doing the open market operation purchase auction. We will be purchasing the government securities worth 60,000 crores so that we can provide the 60,000 crores of the money in the economy. Any confusion here? So remember that whenever the RBI wants to increase the liquidity in the economy, whenever RBI wants to increase the money supply in the economy, the RBI will purchase the government securities from the banks, from the banking system, and RBI will provide the money to the banks for the purchase that the RBI has done. Okay. So this is the open market operation purchase auction that RBI has conducted to increase the liquidity in the economic system in the economy. Next is the RBI has said that the RBI will conduct a 56-day variable repo rate auction for a notified amount of 50,000 crores to be held on February 7, 2025, and this was held. So here you can see that the notified amount of the 56, so tenor of the variable repo rate. So first of all, I hope you all know that what is variable repo rate or what is variable rate repo. So variable rate repo is just like the repo rate, Here the RBI is lending the money to the banks. The RBI is giving the loan to the banks, and banks have to give the government securities or the collateral to the RBI. But this usually happens under the repo rate. Now currently the repo rate determined by the RBI is 6.25%. So RBI has determined the repo rate at 6.25%. So there is a limit of the money that the banks can take from the RBI under this repo rate. Now, if the RBI wants to increase the liquidity in the economy and RBI wants to provide more money to the banks even higher than this repo rate limit. So there are the variable repo rate. There is the variable repo rate auction that is conducted. Variable repo rate auction that is conducted. So in this variable repo rate, the repo rate is not 6.25. The repo rate is variable, that is decided by the market. Okay. So here are some norms, operational guidelines for the variable repo rate. So the auction of the variable repo rate, it is conducted on the CBS, on the core banking system platform of the Reserve Bank of India. The minimum bid amount that the banks can bid. So minimum bid amount for the auction would be rupees 1 crore and multiples thereof. The allotment would be in multiples of rupees 1 crore. Okay. So basically the minimum bid amount is 1 crore. Okay. And multiples thereof. Banks would be required to place their bids in percentage terms. So banks will have to put the bid that if they want to take the money, let's say they want to take 10 crores or they want to take 20 crores or they want to take 5 crores. So at what rate they will want to take it. Okay. And the rate cannot be the rate that they will be bidding at. So bids cannot be at or below the fixed repo rate. So if the bid is below the repo rate that is fixed by RBI, that is 6.25% right now. So bids below that rate will be rejected. So basically bids below 6.25% will be rejected. So banks can take the money from the RBI under the variable repo rate. Let's say they are bidding at 6.26%, 6.30%, 6.31%, 6.35%, and so on and so forth. Okay. So under the variable repo rate, the banks, they can bid that at what rate they will be ready to take the loan from the RBI. Once they have bid that, okay, they will be ready to take 5 crores from the RBI at this rate. Let's say another bank has said that we are ready to take 20 crores from the RBI at this rate. Another bank has said we are ready to take 30 crores from the RBI at this rate. So there is bidding that is going on, and the bidding is in terms of the rate also. So bid should be like above the repo rate. It cannot be at or below the repo rate, and whenever the bid happens, the bid should be at least in 2 decimal. Bids should be in the percentage terms. That what should be the percentage that they will be ready to take the loan from the RBI under the VRR, and the bid should be in 2 decimal places, that's 6.26%, 6.31%, and such. So total tenor for which the repo rate is conducted is 56 days. That means the banks can take the loan for 56 days under the variable repo rate that the RBI has conducted. So this is providing the money. This is providing 50,000 crores of the money to the banking system. And the total amount of bid received was 1,08,702 crores. That means RBI said that we are going to provide you 50,000 under this like variable repo rate that we are conducting the auction for, and the variable repo rate, that is the loan that will be provided under the variable repo rate, will be approximately 50,000. But the bid actually, so RBI said that we will be giving banks 50,000 crores, and for which we will be taking the bids on the percentage terms that, okay, what percentage you want to take the loan at. Now the auction was of 50,000 crores, but actually the bid came for 1,08,702 crores. Okay, so you can understand that how much liquidity the banking system requires, how much money the banks actually want to take more and more. So amount allocated in rupees So RBI provided 50,000, 10 crores. Cutoff rate, that is, see the rates, let's say different banks has said different rates. Now these rates will be kept in ascending order, sorry, will be kept in descending order, that is from higher to lower. So let's say this is the cutoff rate. Cutoff rate is decided that okay, this is the rate at which 50,000 rupees is finished. Let's say different banks has said different rates. So different banks has said different rates. Let's say the first bank is saying, or various banks are saying that we are ready to take 10 crore, 20 crore, 30 crore at 6.36%. Another banks are saying we are ready to take the money at 6.35 crores and so and so. So 50,000 crores, the RBI will say that okay, 50,000 crores of the money the RBI will be able to provide till this level. That the bidding happened till 6.31%. So the RBI will not have to take the rest of the bids because the RBI's money will be finished till this level. So this is the idea that this is the cutoff rate. 6.31% was the cutoff rate. The cutoff rate was the rate at which the RBI money that the RBI wanted to auction has been taken by the banks. Okay. So till this level, that let's say 20 crores is given at 6.36, 10 crores is given at 6.35, 5 crores is given at 6.34 and 15 crores is given at 6.32. Or let's say 12 crores is given at 6.32 and 3 crores is given at 6.31. So 50,000 crores of RBI was finished till the level of 6.31. So this was the cutoff rate. So at the cutoff rate or above that, at the cutoff rate and above that, the loans were given by the RBI. So this is the cutoff rate, that whoever gave the bidding at 6.31% till that rate, the RBI provided the loans. Okay. The average, weighted average rate was 6.35%. That means most of the bids were around 6.35%. So this is the basic idea about the variable repo rate. So I hope you understand that variable repo rate is a short-term liquidity adjustment tool employed by the RBI to provide the liquidity to supply the funds to the banking system. Under this mechanism, the banks borrow the funds, the bank take the funds, the bank take the loan from the RBI at the interest rate that is determined through the bidding process, that is determined through the auction process, and the variable repo rate is usually higher than the repo rate that is fixed by the RBI. Okay, allowing flexibility based on market conditions. So on the basis of the the variable repo rate is decided on the basis of the bidding process, and there is the different rates that the banks can say that okay, we want to bid at this particular rate, and the banks will get the loan if they have done the bid at a higher rate than the cutoff rate. Okay, or the cutoff rate is also decided after the bid has been received, because the bids are kept or the bids are placed in the descending order from higher to lower. So the highest is, let's say, 6.40, 6.36. So if you want to get the money from the RBI, you will have to bid at a higher rate. Okay, so this is the idea. So this is the variable rate repo that I have told you the process, because most of the students usually get confused in the variable repo rate. This is clear, yes or no? Variable repo rate. Is this clear? The variable repo rate process, because most of the students, I get the query about the variable repo rate. So minimum bid amount for the auction would be rupees 1 crore and multiples. Banks would be required to place their bids in terms of the percentage that they want to give to the RBI, that is the rate that they are ready to give to RBI, 6.4, 6.40, 6.36, 6.32, 6.31, so till the 2 decimal places. Banks can place multiple bids also. Successful bids will get accepted at their respective bid rates, whatever the bid rate. If I have cutoff rate is 6.31%, but if I have bidded at 3.40%, I will have to take the loan at 6.40% only. Bids at or below the repo rate will be directly rejected. Once the bidding time is over, all the bids would be arranged in descending order, and once they are arranged in descending order of the rates quoted, and the cutoff rate would be arrived at the corresponding to the notified amount of the auction. So this I have told you that once the bids will be placed in the descending order, and it will be seen that the notified amount is getting completed till which level, and that will be the cutoff rate. Okay. Now coming to the last point, so these were the OMO purchase auction has happened, 56-day variable repo rate auction. This is also the to inject liquidity. Last is USD INR buy sell swap. So RBI is saying that we will purchase the USD from the banks. We will purchase the dollars from the banks for the 6 months, and we will be giving the rupees to the banks. For the purchase of this bottle, I will be giving you rupees. So similarly, for the purchase of the dollars, RBI has said that RBI will be giving the rupees. Okay. So USD buy. So RBI is currently buying the dollars and is selling the rupees. And this is a swap option. That means after 6 months, the RBI will return the dollars and RBI will take back the INR. Okay. So this is the USD INR buy sell swap option of USD 5 billion for a tenor of 6 months. So for the tenor of 6 months, the RBI is giving the rupees and RBI will take back the rupees after 6 months. So under the swap auction, minimum bid size would be USD 10 million and in multiples of USD 1 million thereafter. So this is the basic idea, that RBI is purchasing the dollars right now and will be selling the rupees, and after 6 months the reversal will happen. RBI will return the dollars and will take back the rupees. Okay, so this is the swap option for through which RBI is injecting the liquidity in the economy. Any confusion, anyone? Okay, so this is the end, but before that, before showing you the questions, let me show you that if you go to edutap.in, so if you go to edutap.in, you will be able to go to the EduTap's website, where you are getting the free material, in which you are getting the blogs, where you are getting the information regarding the examination, whichever exam you are preparing for. So these are the blogs where you will get the exam information, the strategy, and the different information you can get about the examination, about the subjects and such. Okay, so if you want to know about a particular examination, let's say NABARD Grade A, you want to know about the NABARD Grade A, so you can get the exam information, you can get the strategy that how to prepare for the NABARD Grade A, you can even get the success stories that how the toppers, what strategy the toppers adopted to clear the examination. Okay, so this is the idea. And if you go to main page, if you want to see the courses, so all courses like NABARD Grade A courses and the other courses, you can see that what all will be provided to you, who will be teaching, what you will be getting, at what price you will be getting. So everything is written here, everything is provided here. Okay, so this is it. This is the first question. I hope you will be easily able to answer this question. Okay, this is the first question, so do try to answer this question. This is the homework question that I hope you will be able to answer. Okay, and this is the second question. I hope you will be able to answer this question also. There is construction that is going on in the office, so I don't know how much you are able to hear me out, but I hope I was loud enough that everything was clear, because I'm not able to hear my own voice. So I hope everything is coming clear to you all. There is a lot of construction that is going on in the office, so heavy machineries are working right now. So I hope that I was able to explain to you everything, because I was not able to hear my own voice over the machines. So I hope everything is clear. If there is still any confusion anyone is facing, so do tell me. Okay, so I hope you will be able to answer this question also, and thank you very much. Do give me the right answer of the homework questions, and do tell me, like, if there is any query, do tell me in the comment section. There is a lot of voice that is coming from outside for because of the construction now, so I'm not able to. Everything was fine. Okay, nice. So thank you everyone. Thank you for joining the session. Do give me the right answer of the homework question. Do tell me if there is any question you have. Okay, there is also a surprise that we are going to announce. So there is going to be a surprise that will be like announced today at 5 p.m. So Gurkira sir, I and Devanshu sir, we are bringing something special for all of you, that many of you are worried about, that are we going to cover the whole of the RBI section completely. So you will get this surprise at 5 p.m. that what new thing we are going to bring that is going to help you a lot in your preparation. Okay, so be prepared for this surprise and do attend at 5 p.m. because we are going to bring something very unique that we have not done till now, and we are going to bring something very new for all of you that is going to help you a lot in your preparation journey. Let it be you have the course or you do not have the course, this surprise is going to help both kind of students. Even if you have the course, this is very important for you. Even if you do not have the course, this is very important for you. Okay, so do join. Thank you everyone.